The Consumer Price Index last month had its biggest jump since 2008, spooking markets as investors worried about rising inflation. The Fed is calling it transitory, but top economist Mohamed El-Erian isn't so sure. Mohamed, thank you so much for joining me. This is right at the moment when we want to talk to you and get your take on this. Investors, policymakers are all wondering, is this inflation persistent or transitory? And you're on the record suggesting the Fed should have a little bit more humility in making predictions. So I won't ask you for certainty, but what's the probability that this inflation could prove more persistent than the Fed seems to think?
It's high enough for the Fed to stop repeating this mantra that is going to be transitory. Look, undoubtedly, there are transitory factors. Base effects are one of them. A short-term mismatch between demand and supply is another one. But increasingly, there's evidence on the ground of structural shifts in both demand and supply that suggests that we should have an open mind towards the persistence of these inflationary pressures. And that's what companies are telling us. But typically, macroeconomists have enormous difficulty adding up the micro data and changing the output-based macro approach.
Yeah, certainly the data have been all over the place, which probably makes it even harder. I want to ask you about some big long-term trends, but first, you mentioned the possibility that supply and demand have shifted a little bit. I thought demand was kind of slowing in the big picture as we've got aging population and so forth. Is it possible I'm wrong there?
So the question is, what's going to happen over the next few years? We entered this with this notion of a deficiency of aggregate demand. And it had several elements contributing to it, including demographics. We've come out with a completely different demand paradigm. We've come out with the average household having a very high savings rate, having repressed consumption. We've come out with governments spending trillions of dollars and will probably continue to do so. And then on the supply side, we've come out with more industrial concentration. We've come out with more companies looking to rewire their supply chains. And we've come out with a labor issue as well, a mismatch between labor supply and labor demand. So if you look at this, you've got to ask yourself, how many of these are going to last for the next few years? And if I don't know, let me keep an open mind.
So one more long-term trend that seemed to be depressing prices, people were worried about inflation being too low over the past decade, is technology, whether it's Moore's Law or even as simple as, oh, I've got Uber, I don't need to buy a car. How do you see technology playing into this?
So I've often respected technology, and especially what I call the Amazon, Google, and Uber effects. Amazon, you can bypass the middle person. Google, you can price search and regain some pricing power. And then Uber, where you can bring in existing stock and therefore increase supply. So we have to take these trends seriously, and they're not finished. But I think the bulk of the disruption is more likely to be behind us than in front of us.
Ah, interesting. And one more signal that inflation isn't serious is coming from the bond market, whether it's the 10-year at historically very low levels and the TIPS market. But could there be other maybe forced buyers coming in to keep those yields down?
So I want you to imagine that you are in a bar offering free drinks, and someone tells you that down the road in a few hours, we will no longer have these free drinks in the magnitude you have. You're not going to stop drinking now. What the bond market is telling you is, for now, the markets respect the Fed, and for good reason. The Fed is continuing to buy 120 billion of assets every month. So the market is not going to front run the Fed by much. It's going to wait. And the big question we have is, the longer the Fed risks falling behind the curve, the bigger the adjustments in the marketplace when it happens.
Gotcha. That's an interesting point. One more question then. So arguably, despite the low price appreciation over the past decade or so, there has been inflation in assets. Stocks are very expensive. Even bonds are very expensive. So at this point, what is your recommendation to investors? Commodities? I mean, stocks tend to do okay. REITs tend to do okay in inflationary times.
If you want the whole thing summarized in one phrase, it's what Leon Cooperman said. When asked how is he positioned, he said, I'm a fully invested bear, which tells you even people who are uncomfortable about the market feel compelled to be invested, which is good news for now. But if they sense a crack in the liquidity paradigm, they will just be bears. They will not be fully invested.
And it doesn't leave a lot of buyers on the sideline. Mohamed El-Erian, thank you so much. I look forward to having you back in a few months and seeing where we are then.
Thank you.